Two investments both deliver a 10% return. One involved almost no uncertainty. The other could have wiped out half your wealth. Did they really perform equally well? Not even close. And here is the twist. The riskier asset by itself could still make your total portfolio safer. Today, we uncover how finance measures risk, prices uncertainty, and decides whether a return was truly worth it. This topic is at the heart of finance. Every investment decision asks two questions. What do we expect to earn? And how much uncertainty must we accept to pursue that return? Let's begin with return. A return measures the gain or loss on an investment relative to the amount invested. It isn't only about the price going up or down. It also includes cash received during the investment period, such as dividends, coupons, or other distributions. This is important because an investment can reward the investor in more than one way. Sometimes the reward comes from price appreciation. Sometimes it comes from income. Often it comes from both. But return by itself doesn't tell the complete story. Imagine that two investments offer the same return after the fact. One was almost certain, while the other could have produced a very wide range of outcomes. The final return may look the same, but the decision before the outcome was known was very different. That is why we study both return and risk. Return is the reward side of the decision. Risk is the uncertainty around that reward. By the end of this lecture, you should be able to explain expected return, variance, standard deviation, covariance, correlation, diversification, risk aversion, required return, risk premium, and risk-adjusted comparison. Most importantly, you should be able to think like an investment analyst, not just calculate like one. Let's now move from realized return to expected return. A realized return is what actually happens after the investment period is over. An expected return is what we anticipate before the uncertainty is resolved. Expected return is a forward-looking concept. It summarizes the possible future outcomes by considering both what may happen and how likely each outcome is. In finance, we often think in terms of states of the world. The economy may be weak, normal, or strong. Interest rates may rise or fall. A company may perform better or worse than expected. Each possible state can lead to a different investment return. The expected return combines those possible returns into one summary measure. But we must be careful. Expected return isn't a promise. It isn't a guarantee. It isn't necessarily the return that will actually occur. It is best understood as the center of the return distribution. That phrase is very important. Expected return tells us where the possible outcomes are centered, but it doesn't tell us how spread out those outcomes are. An investment may have an attractive expected return and still be very risky. Another investment may have a lower expected return, but much more stable outcomes. So expected return helps us measure expected reward, but it doesn't measure uncertainty. That is why the next step is risk measurement. When you look at the expected return on the screen, don't think, this is what I will earn. Think, this is the probability-weighted center of what might happen. That mindset is essential for understanding investment risk. Now we turn to variance and standard deviation. Variance measures how far possible returns tend to be from the expected return. In simple language, it asks, how much can the actual outcome move away from the center? If returns are usually close to the expected return, variance is low. If returns can be far above or far below the expected return, variance is high. Standard deviation is closely related to variance. It translates the risk measure into the same general units as returns, which makes it easier to interpret. In practice, standard deviation is one of the most common ways to describe investment volatility. When an investment has a higher standard deviation, its realized return is more likely to be far from its expected return. That distance may be favorable or unfavorable. It may surprise us on the upside, or it may disappoint us on the downside. This is why risk isn't the same thing as a bad return. A risky investment might produce an excellent outcome. It might produce a poor outcome. It might produce something close to expectation. The risk comes from not knowing in advance which outcome will occur. We can estimate risk from future scenarios, or we can estimate it from historical returns. Historical data can be useful, but it must be interpreted carefully. The past is evidence, not destiny. A historical average is backward-looking. An expected return is forward-looking. A good analyst asks whether the historical period is relevant for the future decision. So the lesson is clear. Expected return tells us the center, while standard deviation helps us understand the spread around that center. When comparing investments, we should never compare expected returns alone. The distribution of possible returns matters. Consider the basic decision logic. If two investments have similar expected returns, but one has much higher uncertainty, a risk-averse investor will usually prefer the lower-risk investment, all else equal. If two investments have similar risk, but one offers a higher expected return, the higher expected return is usually more attractive, again, all else equal. The more difficult cases occur when one investment offers both higher expected return and higher risk. This is where the risk-return trade-off becomes central. The question isn't simply which investment has the higher expected return. The better question is the additional expected return large enough to justify the additional risk? There is also the opposite case. An investment may offer lower expected return, but also lower risk. That may be appropriate for a more conservative investor, or for an investor with short-term obligations, liquidity needs, or limited ability to absorb losses. This is why finance doesn't give the same answer for every investor. Preferences matter, objectives matter, constraints matter, the existing portfolio matters. A high expected return isn't automatically good. Low risk isn't automatically best. We need to evaluate the relationship between expected reward and uncertainty. A strong investment decision combines measurement with judgment. Now let's move from individual assets to relationships between assets. This is where covariance and correlation enter the discussion. The risk of a portfolio depends not only on how risky each asset is by itself, it also depends on how the assets move together. Covariance tells us whether two investments tend to be above or below their expected returns at the same time. If two assets tend to perform well together and poorly together, their co-movement is positive. If one tends to perform better when the other performs worse, their co-movement is negative. If there is little systematic relationship, their co-movement is weak. Correlation is a standardized version of this idea, and it is easier to interpret. Positive correlation means the assets tend to move in the same direction. Negative correlation means they tend to move in opposite directions. Correlation near neutral means there is little linear relationship between their movements. This matters because diversification depends on co-movement. If every asset in a portfolio performs poorly at the same time, owning many assets may not help very much. But if some assets hold up when others struggle, the portfolio can become more stable. Here is the key insight. An asset that looks risky by itself may be valuable inside a portfolio if it behaves differently from the other holdings. So we shouldn't ask only, how volatile is this security? We should also ask, how does this security move with the rest of the portfolio? That is the beginning of true portfolio thinking. Now we can discuss portfolio expected return and portfolio risk. Portfolio expected return is conceptually straightforward. It is based on the expected returns of the assets and the portion of the portfolio invested in each asset. In other words, expected return is linear. If we increase the weight of an asset with a higher expected return, the portfolio expected return moves in that direction. The relationship is direct and intuitive. Portfolio risk is different. Portfolio risk isn't simply the weighted average of the individual risks. It also depends on how the assets move together. This is one of the most important lessons in investments. The volatility of a portfolio depends on individual asset volatilities, portfolio weights, and the relationships among asset returns. The correlation between assets can either preserve risk or reduce risk. When assets move very closely together, diversification benefits are limited. When assets don't move closely together, portfolio volatility can fall. When assets tend to move in opposite directions, diversification can be especially powerful. This is why the visual formula behind me includes a co-movement component. That component is the heart of diversification. Diversification isn't mainly about owning many securities. It is about owning securities whose returns aren't perfectly aligned. A portfolio can contain many positions and still be poorly diversified if those positions react to the same forces in the same way. A smaller portfolio can sometimes be more effective if the assets truly behave differently. The practical lesson is this: portfolio construction is about combining assets, not just selecting assets one by one. Let's build the intuition behind diversification. Diversification reduces risk when asset returns don't move perfectly together. The idea is simple. When one investment performs worse than expected, another investment may perform better than expected, or at least not perform as poorly. The stronger outcome from one position can partially offset the weaker outcome from another. This doesn't remove all risk, but it can reduce total portfolio volatility. Diversification is especially powerful for risks that are specific to individual firms, industries, or projects. Think about company-specific problems: a failed product launch, a leadership change, a lawsuit, a production disruption, or the loss of a major customer. These events may be very damaging for one company, but they may not affect many other companies in the same way. By holding assets that aren't exposed to the same specific events, investors can reduce the impact of these risks. But not all risk can be diversified away. Broad economic forces may affect many assets at the same time. Recessions, inflation surprises, interest rate changes, credit conditions, and shifts in investor confidence can influence a large part of the market together. This distinction is essential. Some risk is avoidable through diversification. Some risk remains even in a well-diversified portfolio. Therefore, the value of an asset shouldn't be judged only by its standalone volatility. A high volatility asset may reduce total portfolio risk if it has low or negative correlation with existing holdings. A moderate volatility asset may increase portfolio risk if it moves too closely with what the investor already owns. The real question is, how does this asset change the complete portfolio? Now let's discuss risk aversion. In finance, most investors are modeled as risk averse. Risk aversion doesn't mean that investors avoid all risk. That is a common misunderstanding. Risk aversion means that investors require compensation for bearing risk. Holding expected return constant, a risk-averse investor prefers lower risk. Holding risk constant, a risk-averse investor prefers higher expected return. This is the foundation of the risk-return trade-off. If an investment has more uncertainty, investors generally require a higher expected return before they are willing to hold it. But investors aren't identical. Some investors are more risk-averse. They require a larger expected reward to accept additional uncertainty. Other investors are less risk-averse. They may be willing to accept more volatility for a smaller increase in expected return. Risk aversion is about preferences before the outcome is known. After the fact, a risky investment may perform very well, but that doesn't mean the risk didn't exist. The risk was present at the time of the decision because unfavorable outcomes were possible. Investor utility is one way to summarize this trade-off. In a mean variance framework, utility combines expected return with a penalty for risk. The more risk-averse the investor, the larger the penalty assigned to uncertainty. This utility measure isn't a perfect description of every real human being. Investors may care about taxes, liquidity, time horizon, downside losses, behavioral concerns, and many other factors. But utility is a useful teaching tool because it shows how risk and return can be combined into one preference-based ranking. Next, let's discuss required return, risk premium, excess return, and risk-adjusted performance. The required return is the return investors demand in order to hold an investment, given its risk and the available alternatives. A useful way to think about required return is to separate it into two parts. The first part compensates investors for the time value of money. This is the risk-free component for the relevant investment horizon. The second part compensates investors for bearing risk. This is the risk premium. The risk premium is expected compensation. It isn't guaranteed compensation. This distinction is very important. A risky investment may have a positive expected risk premium and still deliver a poor realized return over a particular period. The premium is required before uncertainty is resolved. It isn't a promise about what will happen afterward. Required return is also connected to price. When investors demand a higher expected return, the current price must adjust to make the investment attractive. A lower purchase price increases the expected return for future buyers, all else equal. A higher purchase price reduces the expected return, all else equal. Now consider risk-adjusted comparison. A common measure is the Sharpe ratio. The idea is to measure expected excess return per unit of total volatility. This is especially useful when comparing diversified portfolios or standalone risky investments. But no single measure should be used mechanically. A careful analyst asks where the expected return came from, how risk was estimated, what time horizon is being used, and how the investment fits into the existing portfolio. Let's bring everything together. A disciplined investment comparison should combine expected return, risk, and portfolio fit. We should ask, what is the expected return? How uncertain is that expected return? What unfavorable outcomes are possible? How does the investment move with the investor's existing portfolio? What return is required for the risk being taken? Does the investment improve the overall risk-return trade-off? These questions help us avoid common mistakes. One mistake is treating expected return as if it were guaranteed. Another mistake is comparing investments only by expected return without considering risk. A third mistake is comparing investments only by volatility without considering expected reward. Another common mistake is ignoring correlation with the existing portfolio. And one of the biggest mistakes is assuming that diversification simply means owning many assets. Diversification works when assets don't move perfectly together. Historical data can also mislead us if we use it mechanically. The past may be informative, but the future may differ. So the final lesson is this: investment analysis is both quantitative and economic. The formulas organize our thinking, but judgment gives the formulas meaning. The best investment isn't always the one with the highest expected return. It isn't always the one with the lowest risk. The best investment is the one that offers attractive compensation for the risk taken, given the investor's objectives, constraints, and complete portfolio. Thank you for joining me today. I hope this lecture helped you understand how finance measures risk and return, and how investors think about the trade-off between them. I look forward to seeing you in the next video.